The broadcast is now starting. All attendees are in listen-only mode.
All right, we're going to get started, guys. Hello, everyone. My name is Michael Piromgraipakd, and welcome to this webinar. Title is Strategies to Protect Your Wealth and Income from Rising Inflation. And if you've been paying attention to anything in the world, the world economy today, you'll notice that we are experiencing something that has never taken place in history. Yeah, the Great Depression was bad, but that was mostly a deflationary event. But what we're seeing today is large amounts of inflation. The government is engaging in massive amounts of monetary and quantitative easing, and this is what is causing inflation in assets in gold and silver, food, energy, gas, you name it. All of it's rising in cost. However, there is one asset class that is actually coming out of a deflationary cycle, and that is real estate. So the four objectives that we plan to address tonight are: what is inflation and quantitative easing, who's responsible for inflation, who benefits and who loses from inflation, and how do you and your family protect and maybe profit from inflation. And here to discuss this is our guest speaker and professional real estate investor, David Campbell. Some of David's investment holdings and development projects have included single-family homes, apartments, office, retail space, hospitality space, and wineries, and his companies have held real estate interest in California, Texas, and Mexico. David has raised and managed over 30 million of private equity, and he has served as a consultant to real estate development companies and hedge funds with projects in excess of $10 billion. David has written 2 books, Hassle-Free Cash Flow Investing and Hassle-Free Private Lending, and is currently the principal officer of Fourth Dimension Real Estate Incorporated, an asset management and private equity firm. So I can go on and on about David, but we are limited on time. So David, the time is yours.
Hey, Michael, thanks for having me on the call tonight. And go ahead, you can go on and on. That's my favorite part of the call. So thanks, everyone, for taking your evening to spend with me and with Michael to really understand what's happening in our economy and what you can do about it. And Michael had a lot of great things to say about me, but I'm really ultimately just a regular guy. I am a business owner, and I have been very successful in that field, and I think differently than a lot of people. But I put my pants on one leg at a time, like everybody else. So Mike covered our agenda really well, and I have a policy, and the policy is no investor left behind. So let's first talk about why this is a free webinar, because there ain't no such thing as a free lunch. I'm in business for myself, and Mike's in business for himself, and we just want to disclose all the agendas right up front so that you're not looking for the secret close. This is it. I own a real estate development company, and I work extensively with investors, and Mike's got a company that sells gold. There is nothing for sale tonight. There's no business for sale. There's no MLM. There's no close. The entire webinar is just designed to provide value to our customers, and Mike and I firmly believe that the more value we can add to someone else's business, the more likely they're going to want to know who we are and potentially do business with us in the future. So that was the hard close for tonight. So let's dig into, and our commercial sponsor, so to speak. So let's dig into the content, shall we?
Absolutely.
So no investor left behind. The first thing that's really key to realize is that what we use to buy goods and services in our country, it has really changed throughout our history. What you have in your wallet now is a Federal Reserve note. It is only has value because of something what our government calls a legal tender law. And you can see on that top bill, it says this note is legal tender for all debts, public and private. And what that means is if you are owed a debt and denominated in dollars, and someone tries to pay you that debt with something in dollars, they try to pay your debt in dollars, and you refuse to take the currency, that is against the law. So that piece of paper in your wallet only has value because our government says it has value. Now, if you look at the bill underneath, this is what we used to use for money. This certifies that there has been deposited in the Treasury of the United States of America $1 silver dollar payable to the bearer on demand. So it used to be you could take that piece of paper, walk to the Treasury, and they would give you your value for that paper in metal. And that was a real money because you can't create silver. What you can create is an infinite number of these Federal Reserve notes, and that's why we call it a fiat currency or a fake currency. And that's whenever you have a fiat currency, you can have inflation. If you're using real currency, which is silver or gold, or just bartering value for value, it's very difficult to get inflation. So let's dig into the definition. And these are my personal definitions. You're going to have to find other people describe them differently. Inflation is an increase in price as a result of two things: increase in the supply of currency and or the increase in the velocity of money. So those two things cause inflation to happen. Not all price increases are inflation. So we want to be really clear. You can have the price double of something and still not have it be inflation. So inflation is an increase in price as a result of money supply and or the velocity of money. And we'll dig into that today so that you really understand what those things are. Quantitative easing is a policy that our government is implementing where they're trying to increase the supply of currency while keeping prices low by reducing velocity. And the general idea is, how can the government solve their problem through printing? And so the government has more money to print without the price of everything going crazy. And one of the ways that the government does that is by discouraging you, the customer, the consumer, the American people, discouraging you from spending your money. And that's kind of a weird thing because everybody knows that the U.S. economy is primarily consumer-based, and if consumers stop spending, we're in a recession. Well, guess what? We are in a recession. I'm slightly a conspiracy theory guy in terms of I believe that a lot of our media is heavily influenced by the government, and the media publishes things that further the government's agenda. And right now, the media wants the general consumer to think that our economy is terrible and that you better go save and not spend, because that is what's going to keep the inflation in check, is reduced velocity. And we'll dig into that as we go on. So what is inflation not? Inflation is, remember I said inflation isn't just an increase in price. It's an increase in price from two specific things. So if the demand for something goes up, or let's say there's more people in the world and there's a fixed number of commodities, you have an increase in demand. That increase in demand is going to push up prices. But is that inflation? In my definition, no, it's not. There's a lot of things that will cause prices to go up and down, but increased demand from population is not inflation. But will it make prices go up? Sure it will. The other is inflation is not a scarcity of goods. One of the things that's happening in the world is if you look at the population, the Western world, Europe and North America, or actually say America and Canada, very small percentage of the world's population. The vast majority is coming from Asia and Africa. And there's the graph to prove it. And what's happening is Asia and Africa want their piece of the American pie, and so they're consuming more. They're consuming more goods. They want more electronics. They want more higher quality of food. They want a higher quality of life, automobiles, etc. Buildings. All of those things are people in the world competing for existing scarce resources. That will definitely push prices up but that's not inflation. Inflation is only caused by currency supply change and velocity change. So we've got two additional forces that are causing prices to go up, but that's not inflation. Inflation is imprinting for money, literally the government adding more fiat currency into our economy. And the more money there is, the more capacity people have to pay, and that pushes the price up. The more money you have, the more you are willing to pay for the goods and services. For example, my mom tells a great story. She's a beautiful woman in her mid-70s, and when she was a kid, she could go to the movies, buy a popcorn, a soda, get into the movie, and have money for bus fare, and it was less than 30 cents. And we all know there's no way what can you buy for 30 cents today? Definitely not a bus fare, movies, and popcorn on that. So by the increase of supply of money, that's pushed the prices up such that the prices change. The other is velocity, and this is a concept that very few people talk about. And if you really want to dig into velocity of money, I'm a big fan of Richard Maybury. He's a great author, and he's written several books from Blue Stocking Press. He's got a great one called Whatever Happened to Penny Candy. And if you want to dig in onto this concept, Richard Maybury talks about velocity in a very good way. So let's imagine a closed economy. You've got a farmer and you have a rancher, and each of them have $100, and that's the total economy. So this is just an example, simplified. If there's only $200 in the economy, it would stand to reason that the most you could spend for anything was $200. And what we're going to prove is that that's not correct because of the velocity of money. For example, if we can introduce a credit system into our economy, which we have, let's say the farmer decides he's going to go buy $100 worth of cows, and he buys those cows, and then he sells $100 worth of corn to pay for those cows, and he can do that transaction, multiple times. The more the farmer and the rancher trade with each other, the more money there is in the economy. Even though there might only be two bills, if they circulate enough times, it feels like more money, especially if there's a credit-based system where the rancher can say, I'm going to buy corn from you as soon as I'll buy $1,000 worth of corn as soon as I sell $1,000 worth of cows. Would you give me $1,000 worth of corn on credit? And if the farmer agrees, then you created money in the economy that didn't exist simply by conducting commerce, right? So who's responsible for inflation? And why does it exist, and who's responsible for it? Inflation is entirely an artificial government-created thing as a result of a fiat currency. And the fiat currency exists entirely to allow our government to inflate the currency. And inflation is a hidden tax. Actually, it's not so hidden if you know what's going on. It's a tax on the people. It's a way for the government to take money from you and have an unlimited budget. The government, the U.S. government, they print the money to buy whatever they want. And if there was not a fiat currency, our government would have to live within their means, and that would give our government limited power, and that would be a problem for the people in power. They want to have as much money as they want to spend. For example, there's a war going on right now, and if everyone in America had to write a check for that war on a monthly basis, I guarantee that war would stop in a heartbeat. Because when the war tax collector came door to door asking for your money, you would just say, no, I'm not going to contribute to that cause. Go fight the war with whatever money you've got. And the war budget would go to zero, and the war would have to stop. But because our government has an unlimited, infinite checkbook, they can do whatever they want. And so that's the purpose for inflation, and that's why it exists. It's a really evil and ingeniously creative plan to gain power, and it's been around for thousands and thousands of years. Even when the Roman Empire had used gold for their currency, when the money would come back in, the money counters would, at the government, the Roman government, they would clip off pieces of the gold and use those extra shavings to make more gold pieces. And that was the first form of inflation. And that's why historically your money is reeded. It's got that ridge around the end to show that it's whole money, that your coin hasn't been inflated or devalued through clipping. Now we just, through a click of a button, we can create inflation overnight. Inflation is a last-ditch effort for a government that's overstretched. It isn't a sign of a healthy economy by any means. It's a last-ditch effort for our government to try to stay afloat. And the general concept is that we've been running a deficit for over 40 years. I mean, if you go throughout history, it's longer, but here's just a 40-year track record. And in that time frame, there's only a handful of years where we actually earned more money. Our GDP was greater than what we spend. And the general concept is, if you, as a homeowner or just a personal regular guy, if you spent more money than you made, eventually you would run out of savings and you'd go bankrupt. Our government never spends within their means because they can just print more money. And so that is why inflation exists, is so the government doesn't have to live within their means. So people talk about the national debt, and the national debt right now is about $13.6 trillion, and you look at who we owe the money to. The vast majority of the money is to China. 42% of the U.S. debt is to China. And this is how it works. It's a game. China knows that we're inflating, and they don't like it, but here's how it works. We pass a bond, because remember, our money is debt. It doesn't really exist. It's fake. So the government says, here's a Federal Reserve note. Who will buy our note? And historically, the biggest buyer of our note has been China and the people that you see here. So China buys our note. That gives us the ability to just click a button and create money in a bank account. And then China has given us cash that then we go and we buy stuff from China. We buy all the stuff that they make. And that's that codependence between America and China. China can't stop buying our paper because then we're going to stop buying their stuff, and that's a problem for China. China needs to manufacture and send us stuff. And so we're in a funky situation. How do we get out of this debt? And it's pretty impossible to get out of. I mean, we're looking at, if you spend more money than you make every year, how much money can you apply towards your debt reduction? And the answer is less than zero. So let's assume that we can have a balanced budget. Okay, our GDP is about $13 trillion a year. So assuming that everyone in America spent an entire year working entirely to pay off the national debt, meaning they didn't feed themselves or clothe themselves or shelter themselves, all they did was work and give all of their productivity to the government to pay off the national debt, it would take us an entire year to get out of that debt. But the reality is, you work and you earn, and then you pay your taxes, and the taxes pay the government, and whatever's left over is available for debt reduction. There is no more left over for debt reduction, so the national debt isn't going away. Here's the other problem with reducing the national debt. If you remember back when on that first page, we were showing that it's Federal Reserve note. If the government paid off every debt that it had, there would be no more money in circulation. Every dollar would have been redeemed. So for the government to get out of debt, all of that paper would come out of the circulation, and how would we function? So the notion of people say, we got to pay off the debt, we got to reduce the debt, it's a very naive concept. It can't happen, and it won't happen. So we've got to just accept that in our financial reality and plan for that. So when we're looking for the size of our debt relative to our GDP, and if you just look on the left side of your screen, it's 1981. On the right-hand side of the screen, it's present day. And clearly, the debt is getting larger and larger in terms of dollar denomination, but in terms of real value as well, because the currency can inflate and deflate and change value, but the debt as it's relative to our production is getting bigger and bigger, and that's a problem. It's a problem because how do we get our productivity and pay off our creditors? Well, the answer has been we just print more and more and more money, and we go deeper and deeper and deeper in debt. And it's a parabolic curve. And there's a slight interruption in the parabolic curve in the the late 90s because of the stock market having a nice run up. So if you look at this is just the national debt, and it's got a parabolic slope to it. And this is why we have such inflationary influences. We would be actually deeper in debt had the government not made so much money on capital gain taxes in the 90s from the stock market. So Obama's job when he took president, he listed out, here's my things, here's all the things I want to do. And we're halfway through his presidency, and really, this isn't a political commentary, but his main job is to increase the money supply. Because without an increase in the money supply, how are we going to pay the interest on that debt? How are we going to live day to day on our government situation? We've been in a very weird bubble for inflation. Most people, if you are 35, maybe 40 years old or younger, you haven't lived through heavy periods of inflation during your economic viability years. My parents, they've lived through a couple periods of high inflation. They remember when inflation was 10, 15%. If you see, this is a chart that I did an overlay with wars. I took the U.S. inflation rate and I put the major wars of this decade on top of it, and it's very clear that high periods of inflation kind of correspond with wartime, and it's usually a lagging indicator. You go and you create a bunch of money to pay for your war, and that money is in circulation, and then people finish the war and they feel more prosperous because the war is over, and then velocity picks up. So if you've got the double whammy of increased supply because of war spending, increased supply of currency, I should say, because of war spending, and then increased velocity or increased spending because of just a feeling of prosperity, that's the double whammy of inflation. I see in our future a huge period spike in inflation. Some people are going to go radical on one side and say doom and gloom, and you better get your guns and your bullets and hide out in the hills kind of inflation, and our currency is going to zero. You better stockpile gold. Okay, that's possible, but there's the other side of the coin, which just says, well, what happens if we get 10 or 15% inflation for a period of 10 years? What does that do to you? Because I think, that whole conspiracy, or maybe a conspiracy, but just that radical viewpoint of currency going to zero, well, that's possible. Well, I think it's a more moderate viewpoint and a more logical viewpoint to say we're going to have 10%, 15% inflation for a period of time. It's happened in the past, and all of the indicators are saying that it's going to happen in the future. So, don't bury your head in the sand. It's going to happen. One of the reasons we have not experienced inflation already, part of it is reduced velocity, and part of it is the housing market collapse, right? There was a huge boom in the housing market. People had lots of money. People were feeling prosperous. When the housing market, let's say, for example, there's 100 houses on a street and they're valued at $100,000, and then somebody sells, 100,000 times 100, whatever that number is, that's the total value of that neighborhood. When someone sells their house for $120,000, all 100 of those houses go up by 20,000, so you've added $2 million worth of value to the economy. And if you can get loans against it, etc., then all of that wealth pours into the economy, and that's a big stimulating inflationary factor. When the housing market collapsed, it literally sucked a huge amount of wealth out of the U.S. economy. Whether that happened on accident or whether that happened deliberately as a way to forestall inflation, I'm kind of the opinion that it happened a little bit deliberately. We were having a huge stock market boom, and then when the bust happened, we were, early 2001, stock market collapses, and how do we get out of this this bust of a stock market collapsed economy? Well, let's stimulate the housing market by making financing cheap. And then when we want to make inflation, curtail inflation, you just take the legs out, the financing legs out under the housing market, and it'll collapse. Trust me, if the government wanted to prop up the housing market, it would be very easy to do and stimulate with financing incentives like they did in 2001. Just make it all of those financing derivatives, and if you've got a pulse, you can get a loan type of deal. That would solve the housing market, but I don't think our government wants to solve the housing market problem yet, because they have a lot of money to spend, and they want to spend it before inflation happens, or inflation is reflected in price. So where's consumer sentiment? Where is the velocity? It's at a very, very, very low point. And the question is, what happens to prices of things if and when consumer sentiment returns? And I think it's a matter of time. We aren't going to live in caves and feeling sorry for ourselves forever. Eventually people are going to get out and spend the money that they've worked hard to have. So if we have a forecast for increase in velocity, that's good. What's happening to money supply? And we saw our debt grow exponentially and parabolically. The parabolic curve means it's growing up by a compounding factor. There's not a linear factor. And this is from the St. Louis Federal Reserve, and they're showing a radical increase in the money supply. Well, what do you know? Let's go back to that chart about inflation. Well, if the money supply goes up, wouldn't you expect inflation to go up? And the answer is that not yet, because who has the money? You and I don't have the money yet. The money's sitting in the banks. The banks have it. The government has it. The banks aren't letting that money out yet. The government created the money so that they could use the money to buy their own bonds, so the government could fuel their own agenda without having to tax you. So the money's there. We haven't felt the inflation yet because the banks haven't gotten rid of the money. Now the Fed says, oh, it's not going to be a problem. Inflation won't be a problem because we're just going to take that money out of circulation. And I don't buy it. I don't think that the Fed can actually remove the money from circulation like they say they can. The way that the Fed has traditionally manipulated the inflation is through increasing interest rates, which, as the rate goes up, then you spend more of your money on interest, which is good for the banks, but it's not good for the consumer. That kind of draws money out. The other thing the Fed can do is they can change the reserve ratio requirements for members of the Federal Reserve. And so if you're a bank, you can usually lend out a multiplier of your equity based on your deposits. And you can go to the Fed and borrow money to lend out. Well, right now, the Fed is not letting the banks lend out their money. They made those ratios more restrictive. They made lending harder. You saw a bunch of banks close this year. Part of that is because of just loans going bad, and a huge part of that is the government deliberately making banking harder to participate. The government wants to wipe out all of the small banks and leave only the big banks standing. So if you're a small local community bank, the government made the regulations so onerous that it's putting them out of business, and you're going to see that trend continue. So if you're looking at, here's the first, potential, investment concept. If you're investing in bank stocks, I certainly wouldn't invest in small banks because the government doesn't want those banks to exist. So let's look at our money supply. So, here's our chart. Ready? Where's our money chart? Here we go. So we're adding billions and billions and actually trillions of dollars to our money supply in what, 1 year? We added over $1 trillion of new money to the economy. That's a problem. So what is China doing? Because we look back at our chart and we owe 42% of our money to China, and if we inflate our currency, who does that hurt? Well, it really hurts China, because we're going to pay their debt back with devalued currency, and it hurts China only if they deflate, if they inflate slower than us. And as this chart shows, China is adding money like gangbusters. They're adding money to their their economy, exponentially faster than us. I mean, you thought we were out to rip off the world by inflating our currency. China is done it, 10 or 100-fold, more. So that's maybe not 100-fold, but they're doing it radically more than the United States. So let's look at what's happening with inflation around the world. And the top chart is 2008, and the bottom chart is 2009. And the economists generally say a healthy rate of inflation is between 0 and 5%. And so those are going to be your light blue colors and maybe your dark blue, purplish colors. So if you look at the top one, that's 2008, and there were a lot of countries in that blue healthy range. And you look at 2009, and you'll notice South America and Asia, in particularly, and Africa, radically ramped up their rate of inflation. They're in the 5 to 10% range, and there's a lot of countries that are actively now in the 25% per year annual rate of inflation. Anything double-digit inflation is, historically considered hyper inflation, and that's unstable for the economy, because if the price of things go up, for example, 25% per year, that's 2% a month. If you know that something's going to go up 2% next month, you're going to rush out and buy it as quick as you can. You don't want to hold on to your currency because things are going to be worth more or cost more, not worth more. They're going to cost more a month from now, so you better get rid of those dollars and go buy stuff with it. So there's some pretty smart people that have commented on what our government is doing with our money supply and what that's going to happen. And here's the governor of South Carolina, very outspoken on controlling government spending, and he's saying we're borrowing so much to fund stimulus that it could result in inflations like Weimar Germany. John Hathaway, very smart fund manager, he's saying that inflation success is going to be so high to alleviate our debt burden and rekindle the appetite for risk in the private sector. Basically, Helicopter Ben Bernanke, we call him Helicopter Ben because he says if deflation rears its head, we are so worried of deflation that we will actually fly helicopters over the cities of America and drop cash down, just to stimulate spending. So very clearly our government is more afraid of deflation than it is inflation, but you've got other people saying inflation is potentially risky. And people reference Weimar Germany, post World War I. The inflation there was so bad that the prices of things doubled every 2 days. And so it was just financial instability. Zimbabwe had another horrendous period of inflation over the last 2 decades, and such that I carry around a $1 trillion bill in my wallet, and it's just an interesting reminder. Actually, no, it's a 50 trillion. I just checked. I got a $50 trillion bill in my wallet from the Republic of Zimbabwe, and that would buy me even a can of Coke today. But when they first started printing that currency, 30 years ago, $50 trillion would have purchased every piece. No, I take it back. $300 billion would have purchased every piece of real estate in Orlando, Florida, in the 80s. And in 2009, say, you could have paid off that debt. That $300 billion that would have bought all of Orlando, was worth about 2 or 3 chicken eggs, and that's all it was. So if you were smart enough to have borrowed $300 billion in the 80s, you could have, I say Zimbabwe dollars, if you borrowed $300 billion Zimbabwe in the 80s, you could have bought all of Florida, Orlando, Florida, and then repaid that debt with 3 chicken eggs. So that's kind of one of the strategies that we're looking at, is how do you beat inflation by being a borrower? So important to know who benefits and loses from inflation so that you can be on the same side as the person who wins. If you know who loses from inflation, you don't want to be that person, because clearly in the rest of our life we're going to live in periods of heavy inflation because of debt and because of just the international situation, what our government owes, and what our deficit spending is, inflation is going to be a reality. So who benefits? Borrowers benefit. Because if I could borrow $300 billion and buy all of Orlando and then wait 30 years and pay that debt off with 3 chicken eggs, clearly I came out ahead. Trade deficit governments. So let's say the American government, they're a trade deficit government. They actually consume more than they produce. So if you're a country that makes something like China, you send it to America, and we say, well, we promise to pay you back. Let's say you send us a car, just for example. So China, they don't really send a whole lot of cars to America, but I'm just going to make that up as a case study. So China sends America a car, and we say, well, we'll pay you, $20,000 for that car, China. They didn't promise to pay back something equal of value. Hey, let me send you, you give me 100 cars and I'll send you a bomber, airplane. Those are equivalent in value. No, it's you send me, 20. You send me a car and I'll pay you back in this worthless fiat currency. So the more that America can devalue its currency, the less expensive in terms of real objects our debt is. So that helps our trade deficit. It helps if you're a deficit spending government, like I talked about earlier, it gives America unlimited buying power. Liberal governments that say, hey, we want to have all of these social programs for our people, but we don't want to pay for them. Where is it going to get paid from? Well, it's going to get paid from spending. And then an arbitrage lender. So wait, David, you said borrowers win. Well, how can lenders win and borrowers win at the same time? Well, an arbitrage lender is a special kind of lender. An arbitrage means to borrow money at one rate and then lend it at a higher rate, and you make the spread. So if you are Bank of America, do you lend out your own money? And the answer is no. You borrowed the money from all of your depositors, because your savings deposit or your CDs or your checking account, all of those appear on the bank's ledger as a liability because they borrowed it from you. They promised to pay it back. So if they borrowed it from you at one rate and they lend it out at another rate, all they do is make the spread between the two. So if your dollar today buys a can of soda and tomorrow it buys 1 grain of rice, the bank doesn't lose by that devaluation. All of their depositors lost. So the bank has no risk exposure for inflation because they're just making the spread between their borrow and their lending. So that's a concern, or that's who wins. So the government is the big winner for inflation. It's a hidden form of tax. For example, to float our current budget, or to pay off our debt, would you rather have 100% tax on your money or have inflation, right? Well, the other thing is if you've got your money in the bank at 3%, right, and the bank pays you 3% interest, good luck finding that, but I'm just saying, if the bank pays you 3% on your money and inflation is 3%, the government rather, is taking 100% tax on your interest income because the government is devaluing your currency by 3%. So when the bank pays you interest, you didn't really get ahead. You kind of just tread water. Well, where did that 3% go? It went to the government. So if you had, look at a financially illiterate country and people say, well, the government's passed a new tax. It's a 100% tax on interest income. There would be a revolt, riots in the streets because of that kind of tax. Well, if you just call it inflation, or even worse, call it quantitative easing, nobody knows what the heck's going on, and the government still gets their 100% tax on your interest income, but nobody notices. So, here's another conspiracy thing coming out. I think the government has a vested interest in its people being financially illiterate, and that's why there is no financial literacy in the schools, and you're on a webinar like this tonight because this message isn't in the general public. You've got to really tap into people who are thinking beyond what comes on the evening news to figure out what's going on. Inflation causes a misguided feeling of prosperity, so going into election years, you're going to see big, injections of inflation, so people feel good. I was looking at some headlines today while I was walking down the street, and the newspaper stack was said, finally people are getting raises. Wages are going up. Well, wages are going up, but are they going up faster than inflation? And the answer is no. Inflation is going faster than wage increase, but if you got your $1 an hour raise, you feel more prosperous, even though it buys less, short-term memory kind of thing. And it gives our government, unlimited spending. So the disadvantages of deflation, right? The government wins if there's inflation, and the government loses if there's deflation, right? So if deflation is happening, then it makes the government's debt more expensive. There was a deflation happening in the housing market where people were saying, hey, I don't want to buy a house today because it's going to be cheaper next month. So no one buys, and that means people drop their price more, and people see the prices going down, so they wait even longer, and that makes the price go down even further. Imagine if that phenomena happened everywhere in the economy where the price of everything was going down. Everyone would stop buying because it'll be cheaper next week. Why buy a TV today when you just wait next month? It'll be 10% cheaper, and 10% cheaper the month after that. So deflation can't happen because it'll collapse the economy even worse than inflation. What we really need is a sound money policy where deflation nor inflation happens, but I don't have any control over that. Neither do you. So how do you make the best out of a situation where you can't have, honest money? So, you might be able to try to change it politically, but if you can't beat them, you just got to join them, right? So you're looking at, here's the true cost of borrowing, right? So I was talking earlier about banks borrowing and then the rate of inflation. So if you put your money into the Bank of America, so here's the second lesson for the night in terms of tactical strategies to do. The first was be careful with small bank stocks. The second is looking at savers. A lot of people are saving money, and saving is not an investment. Putting your money into a CD is not an investment, because in order to have I went backwards. Here we go. Here's the interest rate for borrowers. So if you borrowed money at 5 and inflation is 10, what did it cost you to borrow? So I guess the lesson we're talking about is borrow to make a profit. So if you can go to your bank, get a home equity line of credit at a fixed interest rate, or refi, or go out and buy an investment property with a long-term fixed rate debt, and inflation is 10%, the government rewarded you for being a borrower. Well, that's good, right? Because the government wants to reward themselves for being the biggest borrower. Banks are the biggest borrower. The banks want to borrow as much money as they can, so they lend it to you at a higher rate. They don't care. Banks don't care about inflation. They actually, banks like inflation because it makes their assets dollar denominated, higher. So if they make you, let's say, $100,000 house, bank gives you an $80,000 loan, and the property goes up in price to $150,000, and the mortgage stays the same at $80,000, how likely are you to default on that loan? Well, not very likely, because you've got all of that equity built in. So banks want you to have equity, and banks want you to have inflation because that creates equity. So if you know that to be true, if your investment interests are aligned with the bank and they're aligned with the government, I think you've got a pretty good alignment of interests. That's a good coattails to be riding on. So, who loses from inflation? And the answer is the average Joe. The average financial illiterate American, or just the average person in the world who's financially illiterate, the government is stealing from them without them even knowing. So if you're a saver, if you're a worker, that's bad because the government is taking your money. And an income tax avoider, here's the deal. People will say, let's go tax the rich. And the reason is you can't tax the poor people because they don't have anything to tax. So you got to tax the rich people. But how do you go tax the poor people, or how do you tax the people that just want to get off the grid? People say, well, I don't pay income tax. It's not legal, whatever, to have an income tax. If the government makes the price of everything more expensive by inflating the currency or devaluing the currency, the government took the tax from you without you having to pay it. So now anyone who uses the U.S. dollar, and that includes Americans and non-Americans. Imagine, I wrote about this on my blog. You could read my blog at hassle-free-cashflow-investing.com. But on my blog, I was writing about the U.S. dollar being the world reserve currency, and we've exported a tax on the rest of the world. Isn't it genius that every country in the world that uses oil and they buy, actually that imports oil or sells oil, anyone that imports or exports oil, so that's everyone in the world, they do that using the U.S. dollar. And if you are India, okay, you're India, and even though rupee is your currency of choice, you can't buy oil in rupees. You can't sell oil in rupees internationally. You have to do it in dollars because that's the reserve currency for oil. And so a barrel of oil is always denominated in dollars. And if you're India, you got to have a huge pile of dollars to buy your oil with. Well, what if America went to India and said, India, we want you to pay us, America, we want you to pay the United States of America a tax. India would say, screw you, America. We're not going to pay you taxes. Well, America figured out a way how to tax India and China and Indonesia and every country in the world, because every country in the world holds U.S. dollars as a world reserve currency for oil. And when we inflate our currency, it makes the dollars that they're holding less valuable. And it's a tax because our government gets to print money and spend it first. And they make the money from thin air and they spend it. Now there's more money in circulation, which makes everyone else's dollars worth less money. Pretty ingenious if you kind of think about it. It's kind of evil and devious, but that's the way that it works. And then this is deviating from our main conversation a little bit, but I just want you to think about it. When you ask yourself, why is America fighting a war in somewhere where it doesn't make sense? Like, why are we in certain countries? Why are we so heavy military in the Middle East? And I'm just going to plant the seed. I have no idea if this is true or not. I just want you to think about it. What if OPEC decided to use euros as the reserve currency? Or what if the world decided, BRIC nations, Brazil, Russia, India, China, and I think also South Africa is looking at being part of that union. What if the BRIC nations said, screw America, we don't want to use dollars for our reserve currency anymore. We're going to create a new currency called the BRIC. And we're going to make it up because we're Brazil, Russia, India, and China, and we're bigger than America in terms of population, in terms of land mass, and in terms of GDP. So we're bigger than you, America, as a group. So forget the dollar. We're going to use the new BRIC currency. The whole world would dump their currency in a heartbeat. And then where would America be? We can't print more money without runaway inflation, and we can't tax all the nations of the world for holding our currency. America would be in a pretty, bad spot economically. So maybe, just maybe, America is using its military force abroad to enforce the legal tender law. Because in America, it's against the law to refuse the U.S. dollar for the repayment of a debt. So if you said, I run a business and I will not take dollars here, that's against the law. The military will come and force you to make that happen. And America's military is abroad enforcing our legal tender law. And this kind of makes me, anyway, I digress, but that's my personal opinion. So if the government lies about why we're at war, of course they're going to lie about the consumer price index. So when you read about CPI, it's not true. So whatever the percentage they say, it's much, much, much greater than what it really is. CPI excludes energy, and it excludes taxes. The average person spends about 43% of their income in taxes. And I'm not just talking about income tax. You just think about all the things that you're taxed upon. Your income, your property tax, your sales tax, transport tax, fuel tax. So let's say you go buy a box of Wheaties from the grocery store and it's $3. Very likely there's about $1.20 in that box of Wheaties that was taxes. All of the fuel that was taxed to get it to market, all of the corporate tax on the company that produced that box of Wheaties, all the sales tax, etc. So the CPI is actually higher than it is. So kind of depressing, David. You really got me down. Like, you're ranting on the government and you're saying that we're going to have double-digit inflation coming up. So how do you protect your family from inflation, and how do you potentially profit from it? Because the very first slide was the inflation tsunami. Are you going to run, hide, or are you going to learn to surf? And if you're smart, you're going to learn to surf. You're going to align your interests with the government and the banks and the Federal Reserve that have every motivation to perpetuate inflation. You want to align your interests with them so that you can make a profit. In a perfect world, we would say inflation is evil. We want sound money. We aren't living in a perfect world, and I'm not Pollyanna enough to think that I can change that. So if you can't beat them, join them. And how do you beat them? Well, you've got to have an earning rate higher than the inflation rate. Because if you are earning, for example, Bank of America has their risk-free CD only 0.6%. I kind of laugh when I see it. I kind of choke up when people, I've invested in CDs. No, a CD is not an investment. It's liquidity. You need to have a CD potentially or have cash to act as liquidity on your balance sheet, but it's not an investment, because if inflation is 3%, the bank's paying you 0.6%, you've got a guaranteed loss of 2.4%. How is that an investment? It's a guaranteed loss. There's no risk. How can you call that risk-free? It kind of makes me scratch my head. So inflation is a foe to savers. If you put $10 in your mattress and cost a hammer was $6 today, you can buy a hammer today. You have enough money. After a year, the hammer's up to $6.18. Well, you can still buy it. But after 20 years, your $10 stayed the same, but the hammer inflated in price. It didn't change value. A hammer is still a hammer. It still puts a nail through a board. It didn't change in value. It just changed in price, because value and price are different. If the hammer went up in price, you can no longer buy it because of the you were a saver. If you invested at, say, 5% and inflation is 3%, well, then you're ahead of the inflation curve, so that you'll always be able to trade your $10 for a hammer and maybe more. But the idea is, how do you really align your interests with the Fed? And the answer is to be a leveraged investor. You got to play the same game that the bank plays. The bank borrowed money from you, and they lent it to other people, and the bank makes a spread. So you've got to figure out, how do you borrow money? Well, the cheapest money is you go borrow money from the bank. And the average person with a good credit score and a good debt-to-income ratio and a good job, if they're using debt secured by real estate, you can probably pick up about $1 million worth of debt before you run into the challenge. So if you can, for example, in this illustration, the hammers, sorry for bouncing around a little bit, I'm just excited. If you could borrow $100,000 interest only and inflation was 3%, and you bought 16,000 hammers to start, right? You go out and you buy 16,000 hammers with your $100,000, and then after 20 years, you go to repay that debt, you only have to give them 9,500 hammers back to repay the debt, and you get to keep that 7,000 hammers in profit, right? You borrowed 100,000, you paid back 100,000, you just were able to repay that debt with a commodity that made your debt pay off. Hopefully that makes sense to you. Really, you can't go borrow $100,000 and buy hammers. The bank's not going to give you that money. You got to go buy real estate, because the bank will give you money to do that. You could borrow from a bank, you could borrow from your friends, you could put syndications together, etc. So how do you outpace inflation? If inflation is 10%. So as a real estate investor, we make money lots of ways. The first is appreciation. Appreciation is increase in value, right? People like the neighborhood, and there's increased demand, restricted supply. That's appreciation. You can also make it from inflation, right? I don't care if my home goes up in value. I just want it to go up in price. Maybe I bought my home today, and there's 100 people that want to live in it, and maybe 20 years from now, I bought in the ghetto, and there's only one person that wants to live in my house. But if I bought it for $100,000 and I sell it in the future at less value, but I sold it for $1 million, well, hey, I'm okay with that. I made a $900,000 profit when it went down in value. Maybe a Toyota costs $20,000 today, and it costs $1 million when I sell my house, right? So my house went down in value, but I made a nominal profit, and as an investor, that's important, is making a nominal profit. Ideally, so the difference between what you borrow, which is your mortgage, and your price of property, that's yours to keep. That's profit. The other is inflation-adjusted cash flow. As the price of everything goes up, so does the rent. Obviously, your maintenance expenses go up over time, but your debt expense, it stays fixed. It stays flat. So your profit goes up and it widens. You know, you're looking at your monthly net profit being the red line. When you start out buying a property, very little cash flow. Very, very little. Because all of the money is going to pay your expenses and your mortgage. Over time, inflation makes rent goes up, but your mortgage price stays the same because you've aligned your interest with the Fed. As if prices go up, your mortgage becomes cheaper, right? Remember that? So as the price goes up, your net monthly income goes up as well. So usually, here's a good another takeaway. Usually, rate of inflation and interest rates have mirrored, kind of gone mirror image. So as inflation goes up, the interest rates go up as well. So one of the big takeaways on the seminar is if you can get a 30-year fixed mortgage, you know, what if you were smart enough, you know, in 1971 have taken out a mortgage at 7%? Oh my gosh, 7%, David, are you kidding? That's ridiculously high. Who would want to do that? Well, for the vast majority of that 30 years, that was the cheapest rate there was available, right? So here we are today where you can get a loan in the 5% range, and people are afraid to get into debt. And that kind of flummoxes me. It kind of makes me curious, right? Because if you could have gotten a 5% loan, in 1971 and just held on to it, the rate of inflation was over 5% for the majority of that time, at or near 5%. So you would have done great. The government would have paid you money to have that mortgage out. It's kind of a weird concept for the government to pay you to have to be a borrower, but that's what they do. Here's other takeaways. You want to borrow at a low rate and invest at a higher rate. And if you can borrow at a fixed rate and you can lend at a fixed rate, well, that's great. You can borrow at a variable rate and invest at a variable rate. And as long as there's a spread between those two, you're going to make money, right? You get to be the bank. If you try to take whatever your resources are, let's say you've got $50,000. If you try to take your $50,000 and go invest it, and that's all you did, you're not going to beat inflation because you're going to invest it, your own money, and there's a cost to you, that money. That cost is inflation. If you borrowed the money and then invested that money, you have exempted yourself from the risk of inflation because you're going to borrow money and then you're going to repay it with devalued currency. So, you definitely need to borrow money to be successful. When you're looking, and there's lots of ways to do it. You could be a real estate investor. You could just be a lender, where let's say you went to your bank and you borrowed $100,000 at 6% and you went and lent it out at 12%. So you're making a spread, that 6% spread. In a perfect world, you would have a more inflation-friendly investment than that because your liability is devaluing with the currency and your asset are devaluing with the currency, but still you've got that spread, which is profit, which is what you're looking for. So I'll kind of comment on other assets that are, people talk about. Gold and silver, precious metals, gems, etc. Those usually respond favorably in periods of inflation, but again, it's not an investment, in my opinion, because they just keep pace with inflation, right? If inflation is 10% and you have a piece of gold, well, usually the gold is going to go up in price relative to the currency. So an ounce of gold would buy, let's say, 5,000 years ago, an ounce of gold bought a nice suit, a nice man's suit was an ounce of gold 5,000 years ago, and today an ounce of gold buys you a nice man's suit. That relative value hasn't changed over 5,000 years, and I don't think it's going to change. But, at one point, a very nice man's suit might have cost you $2, and now it's going to cost you $1,400 for that same suit. the value didn't change, but the price changed. So gold, it's a nice hedge against inflation. If you think that we're going to have social unrest because of a devaluation of our currency, I think that's possible. You're going to want to have a small amount of gold to conduct commerce in. If you think that America is going to have civil unrest when that happens, for example, I live in a very nice town that's right next to a very not nice town. And in this very not nice town, there's a huge number of people on welfare. And if the California government shuts off the welfare, they're not going to have any money to buy food. So they're going to come to my town and they're going to want to steal my food from me. So if there's social instability and the currency is devalued in such a way, I might want to have enough gold to buy my ticket out of Dodge, get to somewhere safe where I can ride out the storm. So that could be a good reason to have gold. Bonds and treasuries, if I had more time, I would really tell you why these are a terrible investment. Generally, the concept is if interest rates go up, you lose money on a bond, and if interest rates go down, you make money on a bond, and interest rates are as low as they can get. So if you buy a bond, you're pretty much guaranteed you're going to potentially lose money unless you hold it all the way to redemption period. And then you make the face value of the bond, but in that case, you probably didn't outpace inflation. So stock market, I'm not a big fan of the stock market. Money comes in and out of the stock market a little bit too quickly. As people are bullish and excited about the economy, they put money into the stock market. When they get fearful, they take money out of the stock market and they put it in bonds. If you want to be a trader, bonds and treasuries and commodities and equities in the stock market, great place to make money as a trader, just not as an investor. An investor puts their money in and they don't inject time and skill. It's an investment of capital, right? Someone who's actively trading has a business, right? So we'll talk about businesses. Could be a great time to start a business. Today, yesterday I put a job posting on Craigslist for a key position for my company. It's a full-time position, and in 24 hours we've had 63 applicants from one Craigslist ad in 24 hours. So the job market is great for employers. If you want to go start a business and hire people, you can get really quality people for a very good wage, right? And it's a great time to start a business. Think counter-cyclical. When the people make money in down cycles, not in up cycles. So right now, when the world looks like it's going to hell, this is the time to go buy real estate and to start businesses. Because especially if you're a business looking for capital, people don't know where to put their money. So you could very easily attract small business venture capital for your money because there's very few alternatives. The other alternative is real estate, which I'm a huge fan of. I want to put as much of my personal worth into businesses and real estate. Those are the two asset classes that I'm a huge fan of. Robert Kiyosaki's book, Rich Dad, Poor Dad, also Cash Flow Quadrant, very powerful books. If you haven't read those, really encourage you to do so. We're going to open up the floor to some questions. I wanted to keep the webinar to an hour. We're at an hour now, but we're going to hang on there for questions. So in your GoToWebinar control panel, there's a place to type in a question. So if you could type it in and hit return, I'll just, any question you got, be it real estate or business or just financial or economy related, or you just want to comment. Nobody sees your questions but myself and Mike, and we'll just read them on air and answer them.
David, I do have a question from Austin Peak. He was wondering, you had mentioned the U.S. deficit was at, I think, 13 trillion, and he said, aren't we at 14.5 trillion?
You're correct. I took my information from Google, who took it from CIA Factbook, and they have not updated it. But when I went to the World Debt Clock, it was well into the 14 trillion mark.
Okay.
So my data was slightly dated. Sadly, from 2010, which is I think the Google data I took, to now, maybe it was 2009 what Google put for me, $1 trillion in new debt in 1 year. That's insane.
Right, right. He has another question. He says here, my understanding is the Weimar Republic citizens spent the following on real estate. 1914, 25% on housing. January 20, hyperinflation starting January 21, 4% spent on housing. July 22, 1% spent on housing. November 23, 0.25% spent on housing. If this is true, it seems that real estate is not a good hedge for inflation. What are your thoughts?
Well, if you were buying real estate unleveraged, meaning you're just paying cash for it, the real estate will tend to, because remember when he was saying percentage, is percentage of what? Percentage of GDP or percentage of the dollar, the currency denominated asset? I'm going to speculate he meant currency denominated, and if I'm wrong, have him send me another update. But if you're just going to go pay cash for real estate, one house might be worth 2 Toyotas today, or let's say 5 Toyotas, right? 5 Toyotas, 1 house. They're synonymous. You can trade them back and forth. If a Toyota is $20,000, then your house is $100,000. If a Toyota is $100,000, then your house is $2 million, right? The relative exchange between them, it stayed the same. You didn't make a profit, but you didn't make a value gain. You just made a dollar-denominated profit. The deal is, if you can go buy a property with 1 Toyota down and 4 Toyotas worth of debt, right? So then the property goes from, the Toyota goes from $20,000 to $100,000, right? So now you can use your debt and you can pay it off with 1 Toyota or less than 1 Toyota. So your house is worth 5 Toyotas and your debt, you bought it with 1, it's worth 5, and you go pay your debt off with 1 Toyota. That means you've got 4 Toyotas left over. So your investment of 1 Toyota became 4 Toyotas. So you quadrupled your money simply because of the inflation, because the price of everything went up and the debt devalued. So real estate in inflationary times really only works if you're leveraged real estate. It works if you're unleveraged, but really the thing to do is be a borrower, be a leveraged real estate investor.
Right. You have to have the right money structures.
Yeah.
Okay.
That's right. That's right. So, and if that didn't answer his question, please comment again. I want to make sure I get that.
Okay. Well, he did say, it looks like he's the only one asking questions, but he said, it's interesting because it seems if interest rates rise with inflation, that it's going to be a wash with real estate.
So if you are, and that's why I say get fixed interest rate debt. So his point is well taken that if interest rates go up with inflation, that would be an inhibitor to your cash flow. But if you get your debt locked in now, then it makes sense. And here's a fallacy. A lot of people believe that as interest rates go up, values go down. That is false. It's statistically false. So there is no direct correlation in residential real estate between interest rates and prices. In fact, Robert Kiyosaki has a really good point when he's saying people think, the Fed thinks that raising the interest rate will curb inflation. And his point is the opposite, that if you raise the interest rate, from 0.6% to say 5%, right? So the interest rate has gone up and people are paying more interest. That's going to attract an injection of capital from all around the world because people are going to move their wealth from places where there's a low interest rate to a high interest rate. For example, right now you can go to Bank of America and get 0.6%, or you can go to the Bank of Belize and get 5%. Obviously, Bank of Belize does not have FDIC insurance, but they're pretty solid, for a third world country. They're a pretty solid bank, and their currency is tied to the U.S. dollar, and they are attracting capital from Americans because people would rather make 5% in Belize than make 0.6% at Bank of America. So that injection of capital into Belize they've got higher interest rates, which is attracting capital, which is stimulating their economy, which causes prices to go up, not down. So, if interest rates go down, it should be the opposite, right? If interest rates go down, then capital should flee the country to places where there's a higher interest rate, and there's enough check and balance there that it's a wash, that there is no correlation between rates and prices. And I want to be clear, that's residential real estate. When you're looking at commercial real estate, there tends to be more of a correlation between rates and price.
Right. Let's see. There's one more question. Oh, from Austin again. Don't increases in salary lag compared to increased prices in other consumer goods? If so, this means real estate increases will also lag.
That's absolutely correct. So my opinion is the inflation has already happened and it has not appeared in real estate yet. So that means it's a great time to buy. Real estate is going to lag in the inflationary cycle considerably. So I don't think, even though we're seeing consumer price increases in energy for a while, oil's down, but it was up pretty considerably. We're seeing it in consumer goods, especially imported consumer goods. We're seeing prices go up. Real estate prices haven't gone up yet. It's a lagging indicator. So that's just awesome that we've got that buying window extended. And also, real estate is very local. So when I say buy real estate, I don't mean go buy anything. You got to be strategic about what you're buying.
Right, I agree. There's a lot more questions here in Austin. If we have time, we'll come back because you have like 5 other ones here. But let me move on to the next person just to give them a chance to put their questions in. This is from Alberto Castorena. He says, I would like to go over all this information you presented a little slower. Will you post this webinar? Okay, Alberto, I'll get that posted. The next person's question is from Steve. Steve Guadis, what kind of strategies would you suggest for investors who have had their credit destroyed by recent foreclosures?
Yeah, great question. And hey, shout out to Steve. Thanks for being on the call tonight. I think you kind of got a couple key things. The first is, if you're looking at being a real estate investor, the ability to borrow is key. Taking on investment partners, if you don't have your own credit, bring on partners that do have their own credit. Find ways to control property without buying it. It's kind of a weird concept, but you don't need to own the property, you just need to control it. For example, I made an offer recently on about a 6-acre tract of land that was on a freeway frontage in Dallas, and it was a vacant piece of land, and the guy had no use for it because it was attached to a dead shopping mall. So this guy was just holding on to his land, this big parking lot, paying taxes on it, and nobody would lease it, or he wasn't even trying to lease it. So I went to this person and said, look, I will rent your parking lot from you at $10 a year plus your property taxes, and I'm going to just have some kind of economic use for it. So here's a guy who was getting no income, and now he's getting income on his property. Then I went to the city and said, hey, I'm going to take this idle asset and create an economic use for it that didn't exist before. I was going to do some outdoor car sales on this particular piece of lot, and I can get the city to lower my property taxes because I've created economic stimulus and job creation for them. So here's a case where I'm going to lease it for probably $10 a year, plus the taxes are probably $50,000 a year now. They're going to get lowered down to probably $20,000 a year. So my total cost of the dirt is going to be less than $2,000 a month, and I can probably sublet that dirt to various auto people for probably $3,000 or $4,000 a month. So that was a situation in which there was no money down, and I was just using my brain to to add economic value to a property through a commercial lease and then a sublease. So that isn't an investment. That was a business. That's me going to the marketplace and being, having entrepreneurship. So, Steve, you're a smart guy. You could find creative deals like that and have real estate business. The partnership thing makes a lot of sense. The other thing is, if you get in away from residential and into commercial properties, you can get some non-recourse lending. I'm doing some, very candidly, Steve, like you, a lot of people, I had properties that went back into short sale in this last market cycle. I had a pretty large portfolio with a lot of equity, and a lot of those California markets turned upside down on me. So, I had some short sales, go back to the bank, so my credit isn't stellar either. But I just got literally closed on 2 loans last week that were hard money loans, for $500,000 to go do some real estate development work. And the lenders fully knew that my credit sucked, and they didn't care. They said, David, you're a smart guy. We're investing in you and your entrepreneurship and the asset. And I was able to get this hard money loan to do this development project, and independent of my credit. Again, not an investment, it was a business, but still a real estate related, profitable venture.
Right. So you're kind of commenting, you're kind of suggesting like a lease to own, option to buy type real estate deal, correct?
Yeah, you could definitely do that. Lease to own, or what's called wrap financing. You go find somebody that's potentially upside down on their mortgage. I was having a great talk with my friend Ken Gain. Ken Gain is very public about his story. He's an investor in Alaska, and he was a real estate syndicator. He had a huge investment fund, multi-million dollars. The Alaskan economy collapsed. He lost his credit as well, declared bankruptcy, started over, and he went to, and at that time, 30 years ago, the real estate market was upside down. So he found someone with a house that was worth about $100,000, and they owed $130,000 on it. And Ken said, I will buy your house if you just walk away from the property. So I'll just take over your loan that's in place, no money down. So he overpaid for the property by 30%. And a lot of people would say, well, that's stupid. Why would you pay 30% premium to buy a property? Well, he had no other way to get that mortgage, and he bought it with no money down. And today, that house is worth $500,000. So, and the loan is paid off. So now he's looking really smart that he bought a property 30% over value, no money down, using someone else's credit, and today he created that equity for himself. So when you're looking out in the marketplace today, very easy to find people who are upside down on their mortgage that would be happy to just give you the keys and let you start making the mortgage payment. Again, that's a little harder to do because it's not a pure investment. You got to go find those people, but hopefully those are some ideas that are helpful.
Right. So the next question is from Marcus Shooter. I don't know if I pronounced that right, but he is asking, what is your best guess on inflation when it will hit double digit? And this is something I wanted to comment on too. I don't know if you've ever heard of John Williams, the economist. The official government rate of inflation is, I think, 8 or 9%, right? But he did a calculation based on the inflation rate from the 80s or the 70s, and the inflation rate is actually at 20%. I don't know if you've ever read John Williams' blog, but he's a pretty well-known economist, David.
Yeah, I did that same math today, actually. I ran a spreadsheet because I was reading an article that said that last month the official inflation rate was 0.3% per month. So I said, okay, well, what is 0.3% per month compounded over 74 years, which is the average life expectancy in America? So I did it. I just ran a spreadsheet, times 1.0003, times the cell above. And I just ran it out for 74 years, month by month. And it was something And then I got that number, whatever it was. I think $1 became $16 over 74 years. That was about the rate. And then I looked at it as a simple rate of inflation rather than compound, and it works out to about, and that's what you do, is just take $16 divided by the 20 years, and it basically came out to about 21%.
Right. Okay, we have a few more here. Do you have time, David?
Yeah, let's go.
Okay. Brian McGrath is asking, how does inflation impact stock prices?
I would not be the right guy to ask that question to, because I try to stay out of the publicly traded stock market. Generally, what I've read is that stock market and inflation tend to go hand in hand. So that as inflation goes up, the stock market goes up. So that inflation is a friend to equities. But it's not necessarily that you're going to outpace inflation. It's just, it's kind of like gold in that stocks tend to track, just the general trend of the inflationary cycle. And it makes sense because as the currency supply increases, people have more money to put into the stock market, and then that money, the more money that goes into the stock market, it drives the price up. I kind of think the stock market, public stock market, is kind of stupid unless you're buying income producing or dividend paying stocks. Because let's say I own 0.1 million% of Google. Well, what do I get for that? If I walked up to Google and I said, okay, Mr. Google, I've got my one share, what do I get? Like, which pencil sharpener is mine, right? It doesn't work like that. I got to find someone who's the greater fool, willing to pay for my share. It's not redeemable for anything. I got to find someone willing to buy it. And if that game of musical chairs stops and people aren't willing to buy what someone is selling, then you get huge price declines. And
right.
You could have some CEO get caught in bed with some teenage girl, and then everyone who's a shareholder of that stock that's morally offended by the CEO's actions, they're going to boycott that stock, and you're going to have a price drop in the stock. Well, the company might be doing great. They might be having their banner year, the most profits ever, but because of some publicity event, they've got a stock price drop, and I just don't like that game.
Right. And I think Robert Kiyosaki in his new book, Conspiracy of the Rich, he says that, the stock market is based on the U.S. dollar, and if the U.S. dollar is crashing, most likely the stock market's not going to do as well either.
Yeah.
So next asker or person asking a question, Blake Stevens, what books do you recommend for nitty-gritty details of real estate investment? What is the economic book you recommend? And what method do you recommend to acquire gold and silver to limit the transaction cost to get the best deal?
Okay, I will put a book list on my blog. So if you all check back tomorrow night, I'll have a new blog post with my book list. So just come to hassle-free-cashflow-investing.com. In fact, while you're thinking about it now, just go to my blog there and subscribe to the RSS feed. And then when I update my blog with the book list, you'll just get a little ping that I updated it.
All right, we got just 3 questions left. Rob Kipple.
Did you want to comment on that gold question?
Oh, gold. Okay, yeah. What was the question was, what method do you recommend to acquire gold and silver to limit transaction costs and get the best deal? Well, you can purchase gold and silver through an online dealer. They're probably going to give you the best price. I recommend appmex.com. I am involved in a gold and silver business that's an MLM, and it allows you to purchase gold and silver at a premium, and also allows you to build a business at the same time. So I'm actually able to profit from purchasing gold and silver every month and build a business at the same time. So Blake, if you want to talk to me afterwards, I can talk to you a little bit more and maybe put you through a webinar and present to you what I do. There's also ETFs, but that's just like a stock in gold and silver. I don't recommend it because you can't, when you buy a stock in gold and silver, you can't get your hands on physical gold and silver. And a lot of economists recommend doing or investing or hedging your money against inflation by having physical gold and silver. Because let's say the proverbial blank hits the fan and the economy goes, if you don't have that gold and silver in hand, you're not going to be able to get it when everything crumbles. So, Blake, we'll talk more later, and let's move on to the next question.
I'd be a fan of physical possession of gold rather than an ETF, where you just have a paper receipt for gold.
Right.
Yeah, I also will do a shout out to Old Glory Mint
Yeah.
in Salt Lake. That's Wayne Palmer. He owns and runs that mint, and they're really credible. And they have wholesale pricing. The challenge with them is shipping. If you got to pay to have it FedExed to your home, it's quite expensive. Very oftentimes, even though it's cheaper to buy it, from a wholesaler, once you have the shipping cost into it, you might be just as well to go to your local gold dealer and buy it from them. Typically, the way that you buy, it's spot price. If you're buying, numismatic gold, which has a value, just because of its uniqueness, and its uncirculated, collectible value. That's different than if you're just buying gold for its metal value. And if you're buying it for its metal value, it's typically a spot price plus a markup per unit, per round. So if you're buying coins, it might be $1.50 to $3 or $4 markup above the spot price.
Right, and there's also goldsilver.com, and that's by Michael Maloney. He works with Robert Kiyosaki. Rob Kipple is wondering, let's see what this is say. It may be helpful to cover the concept of inflation moving through the economy unevenly, and that everyone's personal inflation rate differs from the BS, stated inflation rate, and depending on, I think he's referring to the government inflation rate, depending on what prices have been pushed up in relation to others and where they personally spend their money.
Oh, that is great. So again, that's such a long answer. I will write a blog on that. So if you could forward that question to me,
okay,
that's an entire blog article for me.
Yeah. All right, next one, second to the last. Paul Kim is wondering, how does your outlook strategy change if housing remains depressed for a protracted period?
I think it's reasonable for housing to stay depressed in terms of value, where one house equals so many Toyotas, right? That's value. In terms of dollar denominated, I think it's unavoidable for inflation to land inside of real estate. And for example, if minimum wage goes up by $1, right? That's a response to inflation. So minimum wage goes up by $1. That means someone can use 45, so there's 2,000 hours in a year, and that means the person's going to make $2,000 more a year. They're going to be able to use about $1,000, for simple math, they're going to use about $1,000 of that to be able to buy, to put into their mortgage, right? A bank's going to give them $1,000 credit for that, and that should afford them about an extra $17,000 on their buying power. So basically, if minimum wage goes up by $1, the person who's on minimum wage can afford an additional $17,000 mortgage, and that additional, so it's leveraged, if that makes any sense. It's not $1, it's $17,000 of borrowing capacity, and that's going to show up in their real estate as well, because real estate, people are still going to need it. It's a commodity that is needed. I'm a fan of gold, but people don't really need it. If you said, hey, there was some alien that came and they abducted all of the gold on the planet, well, we would make do. We'd be fine, right?
Right.
If some alien species removed all of the housing in the world, that would be a big, big problem, right? We can't live without housing. It's Maslow, core, food, shelter. There we go. It's right up there. So to answer the question, I think it will definitely appear in the as a dollar-denominated asset. It will lag in the inflationary cycle, but I think it's going to be a big price increase. Will it increase in value? It's very local. It's a very local answer, and ultimately, no. Real estate doesn't really ever go up in value. It's a structure that depreciates over time. It's always going down in value, but it's going up in price, right? The only thing that really goes up in value in real estate is the dirt, the actual land, the royal estate of the dirt, and then also replacement costs. As a builder, I'm watching my material costs go up. There's a lot of copper in a house, and if the price of copper goes up, it costs me more to build a house. And if wood goes up, it costs me more to build a house. And so that's going to restrict my ability to add supply until the price goes up.
Right, that's a very interesting concept to grasp. Nick Bullen is wondering, at what stage of inflation do banks start raising interest rates?
As a borrower or as a lender, so there's typically a narrow range because they're making the spread. They borrow at one and they lend it at another. Right now, the Fed has created an artificially low interest rate, and they're doing that through buying their own securities. So typically when in an open market, the open market will set the free market will set the rate of interest relative to the rate of risk and the rate of inflation. But in this particular weird part of our market cycle, the government is artificially depressing the interest rate for a couple reasons. One, it's their way to help stimulate the economy. And two, if the interest rates are low, that means that the U.S. government can refinance its own treasuries and bonds at a low interest rate. And so they're trying to keep, so basically imagine our national debt. You can't get a 30-year fixed mortgage on the national debt. It's revolving all the time. 1, 2, maybe 7-year treasuries, right?
Right.
So the government wants to keep interest rates low as long as it can to get a reset on all of its debt before the rates go up. And when that will be, I don't know. But I don't think it's going to go up anytime soon. It should. The interest rate should be about 2-3% higher than what it is now, but it isn't because of artificial means. And I think there's a political thing at work here, and I don't think it'll go up until after the next presidential election.
Right. 2 more questions came if you have time.
Yeah, and I don't have a crystal ball, so at the end here there's disclaimers that this is not investment advice, and this information may just be a total BS, and don't sue me if you use these ideas and lose your shirt. So there you go. There's some disclaimers. But go ahead, Mike.
Yeah. Alberto Castorena is wondering, if I purchase an investment home, are you finding banks lending on 30-year fixed rate, and at what rate will I get it at?
Yeah, banks are doing 30-year fixed mortgages because they are being subsidized by Fannie Mae, Freddie Mac, which is ultimately, even though it's not officially a USA government agency, it kind of functions as if it were a government agency. So you're looking right now for an investor property, maybe 5.25% on the 30-year fixed, and if it's a owner-occupant resident property, you're looking in the high 4% as an interest rate.
Okay. Well, The last question, I think he got the answer to. So, but I was going to say, David, I had never seen your presentation before, and there's an alarming similarity to what I present too. And what's certain is that the economy is going somewhere really bad, and we're going to probably see a very large wealth transfer, probably in history that we've ever seen. So with that said, David, I want to thank you for taking the time to present to us, and I've gotten thank yous from a lot of people here, and I think when we're done here, I'll give you that information that you asked for.
Terrific. Thanks, everyone, for your time tonight, and I hope this information will help your family be more prosperous.
Cool. Thanks again, Dave.
Yeah, thank you.
All right, we'll talk later.